Is Japan about to screw over the US? It's complicated. Let's talk about the Japanese carry trade to kick off my Black Swans of 2026 series. Now, I made a video about this before and it's actually playing out in real time. So here's the recap. For years, Japan kept their interest rates near zero, even negative around 2020. So as an investor, you could go to Japan and get money for free, basically. You could borrow money for free and then go buy something like US Treasuries, which more or less have guaranteed returns. So like using free money to go make easy money. So it's kind of like free money. But here's the thing. Japan has a really shaky economy right now. They have a ton of debt, and their bond rates are now going up because they are a shaky economy. And that means that these investors that borrowed money in yen are now selling off their US treasuries. And here's where things go really bad for the US. If that happens, which it is happening, that means rates on bonds are going to go up because there aren't replacement buyers, so rates need to go up to attract new buyers. And here's a critical issue. When even if the Fed cuts rates, if bond rates go up, that means higher credit costs like mortgages, corporate borrowing, government financing. So essentially, debt is more expensive, and that's really negative for stocks and economic growth. We saw this play out over the past couple of weeks, and it really came to head on Friday. In response, the Fed stepped in with dollar liquidity swap lines, which is just a fancy way of saying that the US lent dollars to Japan so they wouldn't dump US treasuries all at once. Woo ish. But, anyways, the situation did stabilize, but things are really, really shaky. If Japan yields continue to rise sharply, which they started to again shortly after this injection, it's going to cause the Japanese carry trade to unwind really quickly, and the market will be in really deep doo-doo. And what the Fed can do is that they would essentially have to start buying up US treasuries to keep that interest rate stable so that credit stays low, credit interest rates stay low. But this is bad because they basically have to just like create money out of thin air to buy those treasuries, and that will create inflation and devalue the dollar. Boo. So it's a complicated situation, but what you need to keep an eye out for are Japanese bond rates rising? Is the dollar rising quickly against the yen? And are US Treasury rates and bond yields rising? If that is the case, the stock market's doomed. If it's not, everything's going to be okay. TBD, stay tuned. I will keep you informed.